Hi there, everyone. Just a quick run through of the income investment we've got coming up in February 2026. I'm Mark Gardner. I head up the structured products here at MPC Markets, and it's going to run you through the investment we've got this month. Particularly, it's the first time we've done the banks here in Australia, and the coupon investment is going to be yielding around about 9.8% per annum, paid quarterly. For anywhere up to 3 years, a minimum of 6 months. So for those of you who are new to fixed coupons, so they blend zero coupon bonds and derivatives. They deliver higher fixed interest payments and significant capital protection. So the principal is fully preserved unless the underlying assets or one of the underlying assets falls more than 40% at the maturity. Hence why we put in the 3 years, and we're very strict and stringent with our stock selection policies. The robust 40% barrier provides strong downside buffering, and while you get consistent coupons paid unconditionally, making them highly attractive for income with very controlled risk. So for those of you who purchase stocks for dividends and don't like the volatility of them going up and down and being at the mercy of the market, very suitable. For those of you who are in hybrids, it's a very, very similar product with very similar principles, just done differently. Essentially, hybrids is a very good example of a mix of equity and a mix of of income, basically. So just done in a very different way. So how they work generally, we will put a basket of 3, maybe 4 carefully selected stocks. Coupons are paid quarterly in cash to your nominated bank account, sometimes monthly, depending on the deal. And after the term, your capital is returned to that same bank account your coupons is being paid to, as long as the stocks are above the barrier. And if the barrier is breached by one of the stocks at the end of the term, you will receive the stocks. So that's why it's so attractive to be doing them on the banks here at the moment. As I say, this is the first time we've done it on the banks because generally the banks have been at quite high PEs over the last sort of 18 months or so. And now that the likes of CBA have pulled back from the highs at 192 back to around about the 150 mark. And the other couple of the other big four that we've included in this basket have pulled back as well. We're getting far more reasonable valuations and prices. So that's why we're considering them now. So our stock selection process, when we're using diversified baskets, we use an Altman Z score, which is a financial health and bankruptcy risk, and a Piotrowski score, which is a scoring system up to 9, which is the same categories where you get a score out of 9 as the maximum. And that's the strength of a company's financial position, because really what we're looking for when we're doing fixed coupons is we don't want the stocks to go down. It is not necessarily about wanting growth out of the stocks and them to go up. We are just really protecting against that downside barrier as much as possible. With the banks, we use a slightly different risk metric. So CET1 ratio, or their capital requirements, higher is better here, and their net, so they're non-performing loans as well. So lower is better here. So they both fall well under. That's 1%, and that's CBA Macquarie there, and CET1 ratios here. They're well within the bounds, better than nearly every global bank really in the world. Highly capitalised, and as we saw on the GFC, the 4 pillars policy. The RBA backed them with liquidity. The government backed them, backed all of these banks with government guarantees to hold up the banking system. So it was one of the things that saved us in the GFC from not going into recession. So essentially, this is roughly about as safe as you can get. And most of the hybrids, which are basically being delisted over the course of the next couple of years, that these banking stocks have, even including franking, would still come in underneath where we've got this one priced at around about the 9.8. So diversification with these, we don't just do one fixed coupon. We highly recommend doing, anywhere around 4 to 6 fixed coupons. Then at least if you, with diversification across the stocks, we've done around about 16 deals in the last 18 months or so. It's been by far our highest selling product. But in the unlikely event that you do have one stock go through and breach and mature at the barrier, which we haven't had as yet, out of those 16 deals, I believe only one stock has even gone under the barrier. out of all of those deals. But, it can happen. We're not, we aren't fortune tellers. We can't guarantee that they're not going to go down there. It's best efforts. But on average, we've been achieving, around the 12, anywhere from 12 to 13% mark on average. So one of them goes at least, out of say 5, you're still going to get 8.65. And over a 3 year, you're still going to get 9.52. And obviously when you receive the stock, that you still can just ride out that stock, and obviously make back that money. So I'll just explain a straight fixed coupon note here using 10% per annum as an example, just to make the maths a little bit easier. So scenario 1, all stocks remain above the barrier for the entirety of the 3 years. And the worst performing stocks up 10% in the basket, say. And as you can see here, stocks can move around as long as it doesn't breach the barrier there. You get your $2,500 every quarter, which ends up being $30,000 after 36 months or 3 years at 10% per annum. And you receive your capital back. Everything gets paid into your nominated bank account in cash. Scenario 2, stocks drop below the barrier. One of the stocks drops below the barrier at some point during the period. What ends up happening here with the straight fixed coupon is the coupons keep getting paid, and then the stock comes back above the barrier. Then again, straight away, say for instance the stock is down 35%, for instance, but at the end of the 36 months, as long as it's above the down 40 or the 60% or barrier or 40% downside, you just get your $30,000 in coupons the entire time at $2,500 a quarter over that 3 years, and your $100,000 capital back. So scenario 3, which is a bearish scenario, is that at expiry, one or more of the stocks remain below the 40% downside barrier. At the 60% downside barrier, which is the down 40%, you would receive $60,000 worth of stock. And then say, for instance, we're down 41%, you get $49,000 worth of shares in that stock. You can nominate for cash equivalent. But with the banks, why would you? You would probably just stick with the bank investment. But you've still received your coupons along the way. So even in that scenario, over 36 months, you're only down to sort of 15% return on investment, and obviously you've got your stocks there. 59,000 in the worst stocks, say down 41 or 55,000. And then you've received your coupons as well on top. So, not great, but not a disaster. Hence why we obviously suggest the diversification. So fixed coupon notes will generally yield a lot lower, when we're talking in fixed income terms, 1% or so is a lot lower. So a fixed coupon note on these banks at the moment is more like 8%, or 8.3% per annum. Not the 9.8. And where we get the 9.8 is, so we're using what's called a Phoenix memory. Now, funny name, but obviously Phoenix rising from the ashes. The only difference here is on this, say this month here where it breaches and one of the stocks is below the 40% barrier, you don't get your coupon that month. But when it comes back above the barrier, you get back paid that coupon. And you receive your coupon again. So basically, that having that little feature in there essentially raises the overall yield to around about this 9.8. Bearing in mind as well, people, that if prices can change 0.5% either way. So 9.8 is probably about fair at the moment. But this investment, if we get a period of low volatility, for the next 2 weeks, that could fall away to about 9.3 or 9.2. It just sort of depends. We're just using an example of a deal that's been done as of today, the 4th of February, which strange got 9.96. So it will vary somewhat, but we tried to get predict on the low side, and then hopefully we've got some buffer to make sure that we're meeting that quoted yield, but it's not a guaranteed yield as quoted. And again here, this is one scenario here where, say it drifted below in the last quarter, you would not get your coupon payment in that quarter, and then you would receive the stock. So that 30,000 in coupon payments becomes 27.5, but still not that big of a deal in terms of 59,000 in stock, 27,500 in coupons. So you're still at 86,500, which is 13.5, but you've received probably 1.5% better over the period of time. One common question is, say it was below the barrier for 2 months in a row, you get, and it goes back above, you get all of the missed coupons, essentially. So really the risk is only towards the end. If it was to drop, say, in the last 2 months or so, and you don't, or 2 quarters, you wouldn't get those payments. But again, we believe, particularly with these Australian banks, that it's not, it's really only a GFC style scenario where we're going to get a 40% pullback in those, and they're going to stay there. So it's not of concern, but it's important to us that everyone understands the downside risks and not treat, because this is not a term deposit, it's not a bond, it's not a it's not a traditional fixed income instrument. So, but generally, if you get tricky with them, and this is very low risk with all these banks, you're getting very, very good yield. So compared to common investment income investments, so fixed coupon notes, basically private credit can be a little bit transparent, hybrids, debt equity mix, it depends on, private credit depends on the fund you're dealing with and the transparency. Not all private credit's bad, but some of it is very opaque. Listed hybrids, albeit that, they are very safe, they don't yield as good, and as generally as these fixed coupon notes, even when you include franking, but they are also being delisted by ASIC, so you won't be able to use them in the next few years anyway. Income profile is high for fixed coupons. Private credit can be floating, and but it's probably comparable. And then floating or fixed distributions higher than senior bonds, but they are deferrable. So people forget that hybrids, when markets collapse, they switch off the payments. So they haven't done it for a very long time, but it is possible, and you can receive the stock as well. So fixed coupon notes, there's daily liquidity. So you can, after 6 months, you can request to be out. If most of the stocks are around where we entered, you'd be very little cost. If one of the stocks is very close to the 40% barrier, there would be a penalty to get out. It would vary. It is up to the issuer. Listed, obviously hybrids have a massive advantage because they're listed in T+2 there, so that's probably the best version. But and then key risks, basically they've all got very similar key risks, but private credit particularly, when there's defaults, there's low recovery risks, and illiquidity, and as well, your money can be locked up for quite some period of time. Whereas with the hybrids and the fixed coupon notes, it's far less of a problem. So yeah, in a black swan event like the GFC, 50-60% market crash, fixed coupon notes are probably one of the better choices because you still receive your coupons. If you're doing those Phoenix coupons, you would not. That's why you get paid a little bit higher. But if you do straight fixed coupons, you would continue to receive your coupons for anywhere up to 3 years. So, and that is much better than, say, hybrids, for instance, that can be switched off. The average market conditions, they perform extraordinarily well, and you generally will get higher yields than most other income investments. And in strong bull markets, you enjoy the full ride, and you got the 100% principal protected as well. Many of these fixed coupons have an auto call, which means that the issuer, if the stocks rally too much, can hand back your capital. But here at MPC, we've done, as I said, 16 odd deals in the last 18 months, and we're averaging somewhere around the 12 and a quarter mark across all the deals overall, and we're with only one stock, I believe, going below the barrier at any given stage. So private credit is a disaster in GFC, like black swan events. You're not getting your money back, and you'll be asked for haircuts and etc. And be very difficult to even get an answer from many private credit funds, etc. And that's private credit is not going to survive well in that sort of black swan event, particularly the GFC style where credit really froze up. Average market conditions, very reliable, and you can get some quite great premiums, and it's backed by assets, so pretty decent there. High growth years for stocks, it'll be again pretty reliable, pretty good. So, but if the economy's doing well, and then you're probably not getting those higher returns overall. Hybrids, they will pull payments in a black swan event, and you may end up with the stock. Average market conditions, 6% 7% inclusive of franking credits, but also they're being delisted, so it doesn't really matter in the long term. High growth year, you might get slightly higher as well, but it's still not the coupons that we're going to get through these fixed FCNs. We formulate these in-house. We've got a very experienced derivatives and options team, and we're very, very careful with our timing. We wait to strike at higher periods of volatility and lower prices to make sure that not only the barrier isn't under threat, but also we're getting the best prices overall. So we basically pull these together ourselves with our own risk models. There's a bunch of our deals. When in April, for instance, we did three really close together around that 13 mark when volatility was very high. All of those are miles above the barriers. Obviously, they're the best time to do it in those times of panic. Our REIT fixed coupon note was the first one we did. Matured yesterday, in fact. It matured early, nowhere near the barrier as well, and paid very consistently over time. But as you can see, the diversified ones, we've got a basket of banks here at the moment as well. When you diversify uncorrelated stocks, like a healthcare stock with an industrial and a bank, for instance, that will increase the yield. So we have tended to do diversified fixed coupon notes as the clients who have been big investors in these have gotten more and more used to it over time. Have been happy for us to select stocks, etc. And you can see there, for instance, the miners fixed coupon note only at 11.85. We have done them on US as well. The volatility is inherently higher in the US. We do get better prices, and everything's priced in Aussie dollars essentially. So liquidity is there's daily liquidity on fixed coupon notes, frequently asked questions. I've explained the downside barrier. Can you invest via an SMSF? Yes, you can. Can the yield of a fixed coupon note be improved? No, it cannot. Once it's agreed at the start of the deal, that is fixed for the period of the investment, but it also can't move down. There are no franking credits involved in these. And what are the fees? Basically, MPC Markets is paid by the OTC provider, which is the counterparty to the deal. In fixed coupons, we only use AA rated banks that survive the GFC, like Citigroup, JP Morgan, Morgan Stanley, etc., Macquarie Bank. We don't use any counterparties outside of those high quality investment banks. We can get better prices with lower grade counterparties, but obviously there is risk there. If a counterparty was not to go well, we don't really use European banks either. There's tended to be problems with those over the course of history when credit conditions freeze up. So, but we are paid by them to bring them the packaged investment. So there are no fees, there are no management fees, there are no commission payments or anything. What we are quoting there is what you get in your pocket, and that's it. So what we essentially get at the end of the day amounts to probably 0.7 per annum potentially at the high side. And we're paid from the OTC provider. So we obviously there is money in it for us. We don't do these things for free, but it is not part of there's not going to be 9.8% plus brokerage. It is 9.8%. That's it for you as the investor. These are not available to retail investors. Unfortunately, we cannot offer them. They are for sophisticated investors only, or S708s. Or professional investors. So, unfortunately, we cannot do them at this stage for retail investors. It's just unavailable. But thank you for listening. I hope you've got a little bit of insight. You can call myself or Kai, 1300 763 869. Our emails are there, mark.gardner@mpcmarkets.com.au, and Kai's as well, or just email invest@mpcmarkets.com.au. If you've got any questions, etc., we'll be looking to close up this round. We'll likely have the Australian banks and an Australian diversified basket. We just haven't decided on the basket as yet. It's still a couple of weeks out. But we'll be looking somewhere around the 16th or 17th of February with this all closing up. So you'd have to register your expressions of interest by the end of next week, the 13th of February. But these are great investments. Our clients here, once they've started on them, they've really taken to them like a duck to water. They've been so happy with the consistency around almost equity index returns with that consistency, and particularly now in a Trump world. Our current clients are just absolutely breathing a sigh of relief. They don't have to deal with that volatility. So they are a great part of a portfolio where you can tuck away a large chunk of your portfolio, know you're going to get consistent income, and then you don't have to worry about messing about with dividend stocks and earning seasons, etc., and market volatility, and take a lot of stress out of it while giving away very little in terms of the return, sometimes probably doing a little bit better. Thanks for listening, guys, and we hope to speak to you soon.